overnight index swaps, a few credit issues relating to it, and the involvement of funding costs and the role that is typically being played by funding value adjustment, credit value adjustment, and the debtors value adjustment, debit value adjustment. Now, just to understand, treasury rate historically before the crisis, what we see is treasury rates are a good reflection of the risk-free rate, right? They are very lower than the other very low risk rates like LIBOR or swap rate. Compared to these are also treated very closer to risk-free kind of rates itself, and typically they are used very heavily in the valuation of the derivative securities also. The derivative dealers did not use the treasury rates for the valuation of the securities, but they were primarily using either a LIBOR or a swap. The reason being the treasury rates generally have a slightly lesser rate compared to the other low risk free rates that are typically available. And it's also like the treasury instruments to a large extent from a regulatory perspective, they need to be held by the financial institutions, which means they are not that heavily for a free trade. So there is a mandatory requirement that some amount needs to be held from a regulatory perspective. And the treasury investments require literally no capital. They have a favorable tax treatment. And because of all these things, why favorable tax treatment? State level tax is not applicable on them. Because of all these things, the treasury tax rates, treasury rates are slightly lower than a typical risk-free rate. So that's the reason by derivative dealers generally they never considered the treasury rate for doing a risk neutral kind of valuation. Rather, they did not use it as a proxy for the risk free rate. Rather, they were depending on the usage of LIBOR or